Good afternoon and welcome to Bulls, Bears, and the Bell. Thank you for joining us. Today, well, we're trying to make sense of what felt like a really significant market reversal. Wednesday, October 22nd. U.S. equities pulled back pretty sharply from those record highs we just saw. And the feeling wasn't just, taking profits. It felt more like a shift in risk tolerance.
It really did. It was a fascinating day, actually, because this pullback wasn't about one big negative event. Instead, it felt like the market was imposing some very swift, very selective justice, punishing specific companies based on their results, all while we've got this backdrop of huge macro uncertainty.
Right, the shutdown chaos.
Exactly. So our mission today is really to cut through that noise. We're doing a deep dive into what happened. We'll look at the mixed earnings reports, the anxiety over the shutdown, and I think critically, this dramatic unwinding we saw in some speculative assets.
And the goal here is to give you that shortcut, that clear picture of this new market environment maybe. Our big takeaway, it seems like the market had two completely different personalities today.
That's a great way to put it. Two personalities.
Yeah, on one hand, you had this, meticulous institutional trading, zero tolerance for any imperfection in big tech names. But then, on the other hand, just pure, chaotic, retail-driven volatility in some of those, let's call them fringe stocks.
It really was a day defined by that divergence and maybe more importantly, an intolerance for risk. I think those days of just buy growth, doesn't matter the price, seem to be fading fast.
Okay, let's hit the numbers first. The overall retreat was noticeable, especially after the run we've had. S&P 500 closed down, 0.68%, Dow down 0.57%. But the real story, the real tell, was the NASDAQ composite. Heavily tech-focused.
Yeah, that led the way down.
It dropped a full 1.00%, closed at 22,724.27. When your growth index is bleeding the most, well, that tells you where the anxiety is focused, right?
Precisely. And that focus, that pain, it forces you to look at valuations. Tech stocks were priced for basically perfection. And as we saw today, even a flaw that wasn't really about the core business, well, it was enough to trigger a big move out.
Okay, let's unpack this tech weakness theme. Because this is where the market's momentum really just hit a wall. And the core driver wasn't simply bad results, was it? It felt more like a psychological shift. Suddenly, those high valuations just weren't acceptable. If anything looked slightly off, investors just stopped giving them the benefit of the doubt.
That psychological shift is absolutely the critical point here. Think about it. So the last year or so, capital's been cheap, it's been plentiful. Investors could kind of stomach a revenue miss here, maybe bumpy guidance there. They focused on the big picture, the TAM.
The total addressable market, yeah.
Right. But now, cost of capital's rising. There's this nagging inflation anxiety. The market just pivots. It goes into show-me mode. Suddenly, it's all about cash flow, margins, clean operations. That's paramount.
And nothing screamed zero tolerance. Louder than Netflix today, case study 1. NFLX shares were just in free fall, closed down nearly 10%, wiped out months of gains one day.
So what was the catastrophe? What actually happened?
Well, the irony here is pretty rich, actually. The catalyst wasn't like a bad content slate or losing subscribers. Netflix missed the consensus earnings per share, the EPS number, because of a very specific one-time non-operational thing.
Right.
A $600 million tax settlement with Brazil, of all places. Now, management tried really hard on the call to frame this as, isolated. They emphasized strong customer engagement, good content coming, the ad tier growing fast.
But the market just ignored all that, focused purely on the headline miss. I mean, isn't that classic punishment for high valuation? Before today, Netflix was up almost 40% this year. Why does a one-off $600 million charge even matter for a company that size? Because when a stock is priced for perfection, any excuse can become a good excuse to take profits, especially when the underlying mood is already a bit nervous. And that $600 million charge, it did cause their operating margin to slide more than expected. In this environment, investors are laser-focused on defending margins. They're basically signaling, we don't quite trust the story that next quarter will just magically fix this dip. So yeah, that sharp punishment, it's a clear sign we're shifting away from that speculative growth mindset. It's about clean profits right now.
And that signal got amplified almost instantly by case study 2. Texas Instruments, TXN, semiconductors have been like the lifeblood of this whole tech boom. So when TXN sank 8%, that fear spread fast.
Oh, absolutely. Texas Instruments, they're foundational. They make the chips, the analog components that go into practically everything. Industrial gear, cars, consumer gadgets. Their Q3 results were, well, mixed. But that wasn't the real issue. The disaster was their guidance, their forecast for the fourth quarter. It was weak.
Okay, guidance is forward-looking. So what does a weak TXN forecast tell us about the broader economy?
It tells us demand might be softening up across major industrial end markets. TKN's guidance is a pretty concrete sign that their big corporate customers are either slowing down production or maybe just using up the inventory they already have. Either way, it suggests a slowdown in capital spending, and that's frankly much more worrying than a streaming company's tax issue. This hints that the recovery we saw in chip demand might be stalling out, or worse, maybe heading back down.
And the ripple effect was immediate and pretty brutal across the sector.
Totally brutal. That warning just dragged down almost every major chip maker. We saw big pressure on Intel, INTC, on AMD, Advanced Micro Devices key for AI chips, Micron, MU, that's memory and storage. So you combine Netflix getting punished for its valuation and TXN warning about future demand. That really set this deeply negative risk-off tone for the whole NASDAQ. It basically signaled that tech, the market leader, isn't immune anymore to what's happening in the broader economy. Reality bites.
So, okay, indices down, tech giants getting punished. But the story wasn't all negative, right? What really stands out is this divergence, these cross currents. If you had strong fundamentals, you actually got rewarded. Fiercely. It really highlights how selective, how bifurcated this market is right now. You really had to prove your worth.
Exactly. This is where the narrative shifts. It's not just generalized panic. It's a targeted rotation into quality. Investors aren't just pulling money out wholesale. They're pulling it from companies that miss expectations, and they're actively putting it into companies that beat expectations. It validates that idea of healthy at the core.
And the clearest example of that in the winner's circle today was Intuitive Surgical. ISRG stock surged, over 15%? Massive move. What gave ISRG that kind of immunity?
ISRG delivered exactly the kind of numbers the market wants right now. Profit and revenue both significantly beat estimates. It shows really strong, growing demand for their Da Vinci surgical robots. But what's critical here is the nature of their revenue. It's not just selling the big machines.
The razor and blades model.
Precisely. They sell the high-margin instruments, the accessories that have to be used with those Da Vinci robots already installed in hospitals. So the revenue is high margin, it's sticky, it's recurring. That insulates them from the kind of cyclical worries hitting a component supplier like TXN.
Makes sense. It validates this clear, almost recession-resistant growth story. Real healthcare tech, high barriers to entry.
Exactly. The valuation gets justified because they have established profitability and this predictable proprietary revenue stream. The market will absolutely pay a premium for that kind of certainty, especially when high beta tech is, crumbling around it.
And we saw a similar reward for clarity over in the industrial space, too, with GE Vernova, GEV, popped up nearly 4%. And the sources point to a very specific driver there. They topped estimates, reaffirmed guidance, specifically because of strong demand from AI data centers for their power generation gear.
GEV's performance is actually a crucial signpost right now. It tells you where capital spending is really strong. This AI boom, it needs massive amounts of reliable power. It just eats electricity. GEV makes specialized equipment that's essential for that, for powering these huge hyperscale AI data centers. So their success shows that even if people are getting cautious about, say, the growth trajectory of some software companies, the infrastructure build out for AI, that's still going full steam ahead. That's durable enterprise spending.
Interesting. And it wasn't just tech and industrials showing pockets of strength. Even financials, which have been, under the microscope, Capital One up 2%, and maybe significantly Western Alliance Bancorp, WAL, climbed almost 3%.
Yeah, WAL's performance was arguably pretty important for calming broader market nerves. WAL is a regional bank. That whole sector's been super sensitive to rate hikes, worries about commercial real estate loans, potential souring assets. So when WAL comes out with better than expected profits, it helps soothe those lingering systemic worries about regional bank stability that flared up just last week. When a potential weak link shows fundamental strength, it actually acts as a big de-risking event for the whole financial system.
Okay, so if we synthesize this divergence, brutal punishment for flaws, big rewards for flawless execution, what's the clear takeaway for you, the listener?
I think the market has basically just raised the price of admission significantly. It's demanding proof of sustainable, profitable growth, not just potential anymore. It's not just about can you grab market share. It's can you make money while grabbing market share. The punishment of Netflix and TXN shows the caution. And the big reward for ISRG and GEV shows the appetite for pure, unadulterated quality.
All right, we've talked about the meticulous institutional trading, the focus on fundamentals. But now we need to shift gears pretty dramatically. We need to talk about the strategic buzz and then the absolute fringe of the market, where logic seems, optional, and volatility is king. This is where those two market personalities really just diverge completely.
The separation is incredibly stark. It really highlights that while the big institutions are carefully crunching numbers on tax charges and margins, there's this whole other segment of the market, driven mostly by, retail enthusiasm, maybe some technical positioning, that's just operating in hypervolatility mode.
Let's hit the strategic side first.
Yeah.
Warner Bros. Discovery, WBD, that was a standout gainer today, added 2.5%, and that was building on a huge surge, nearly 15% the way before. This is all M&A buzz, right?
Entirely M&A buzz. The driver is that Bloomberg report saying there's serious acquisition interest in WBD. We know Paramount Skydance tried and failed before. But the new names being floated, Netflix and Comcast, those are much bigger players. Netflix, well, they always need more content depth, right? They don't own a big legacy library like WBD's. Comcast is always looking for scale. So the potential deal is all about consolidating WBD's library. HBO, DC Comics, Discovery's reality stuff. It's a huge trove.
So that tells us, even with all this short-term earnings anxiety, the long-term strategic value of good content is still paramount. Consolidation in media isn't over.
Not by a long shot. Strategic moves just keep happening. Doesn't matter if the S&P is up or down 0.5% on the day. Meanwhile, you saw the cloud competition play out instantly during the trading day. Alphabet, GOGL, climbed over 2%. Why? Talks about a massive multi-billion-dollar cloud deal with this AI firm, Anthropic.
Right, Anthropic, very influential. And then Amazon, AMZN, fell 1% almost immediately, like a perfect inverse reaction. It sounds like a textbook zero-sum game in cloud.
It really is. Anthropic is one of the hottest AI companies out there. They use enormous amounts of computing power. So, if Google Cloud manages to land a major contract, potentially taking business away from Amazon Web Services, well, that's billions in guaranteed revenue-shifting columns. In the cloud world, it's hyper-competitive. Any rumor of a big client moving, you see capital reallocate instantly. Shows how sensitive the market is to who's winning in the AI infrastructure race.
Okay, now we pivot hard to the fringe. The meme stock resurgence, led by Beyond Meat, BYND. This wasn't just a stock moving. This was like an economic stunt show, driven by pure technical.
Pure technical theater is right. Totally divorced from the company's actual fundamentals. Beyond Meat's underlying business challenges are still very real. But the stock, it performed this, parabolic miracle this week.
Okay, detail the madness for us. BYND was already up 146% on Tuesday, which is insane. Then today, Wednesday, it gained another 64% early on. Hit a high of $7.69. That's like over 1,300% up from its record lows just a few days ago. How does a company with real issues move like that?
That is the textbook definition of a massive short squeeze. Simple mechanics, really. The stock had a huge percentage of its available shares. The float held short, meaning tons of people were betting the price would fall. So when just a little bit of buying comes in, maybe some positive rumor, whatever, it forces those short sellers to cover their positions. They have to buy back the stock to limit their losses, which are suddenly exploding. And that buying creates more buying. It's a self-feeding loop, sends the price vertical, totally disconnected from sales figures or strategy.
The speed, the volume, incredible. But that ride didn't last long, did it? The stock reversed sharply, lost almost all of today's gains, closed around $3.93. And the sources noted trading was halted 14 times for volatility. 14.
14 halts. That's not just high trading volume. That's a sign the market mechanism itself is breaking down. There's no liquidity, no depth. When they halt it that many times, it means the price is moving so violently, regulators have to hit pause just to let everyone catch their breath, figure out what's going on, or maybe what isn't going on. This kind of hypervolatility just confirms that you've got these significant pockets of retail-driven speculation running wild, fueled by momentum, technicals, existing right alongside the cold, hard institutional logic that was punishing Netflix. It creates a really unsettling, frankly weird market dynamic.
Okay, so while institutional money was busy dissecting balance sheets and retail was riding the BYND roller coaster, the entire market was kind of operating under this fog, missing the single most important piece of information it needs for valuation, a real read on inflation.
That's absolutely right. The big shadow hanging over everything is the U.S. government shutdown, now in its 4th week. And it's created this massive system-wide data blackout. And the anxiety from that information vacuum is just building every single day.
And the key consequence, the immediate one, is the delayed CPI report, the Consumer Price Index for September. Normally, a routine release the market treats like gospel, supposed to be out today. Now delayed until Friday, October 24th. Why is a 2-day delay such a big deal? And why is this report so crucial right now?
CPI is just indispensable because it dictates Fed policy. period. The entire valuation structure for the stock market growth, value, cyclicals, everything, it's all based on assumptions about where interest rates are going. Investors desperately need to know, did the Fed's rate hikes actually work? Is inflation cooling down, maybe allowing for rate cuts soon? Or is it sticky, re-accelerating, forcing the Fed to stay tight?
So without September's CPI number, investors are basically trading blind, relying on old data, maybe anecdotes.
Totally blind. And that lack of fresh data has created this immense pent-up pressure. The market just can't confidently price future earnings, can't figure out discount rates without it. Consensus is expecting, what, a 0.4% month-over-month increase in the core index? But the delay has turned this routine release into what the sources correctly called a high-stakes binary event.
Okay, let's explore those binary stakes. What happens if the number comes in hot on Friday?
If it's significantly hotter than 0.4%, well, that just throws cold water on the whole rate cut narrative that's been supporting stocks all year. It suggests inflation's sticky, maybe embedded, and that would likely trigger a major sell-off across the board. Traders would immediately start pricing in fewer rate cuts next year, maybe none for a while. Conversely, if the number is cool, say 0.2% or even lower, boom, that ignites the rate cut optimism. You could see a powerful relief rally, maybe strong enough to completely erase the weakness we saw today. Right now, the market's just trading on these micro stories because the critical macro data is missing in action.
We did get a little bit of international context on inflation, though. The UK rate held steady at 3.8%. That was actually a bit below expectations.
Yeah, just slightly below the 4.0% consensus. And even that small beat was enough to spark some hope for a Bank of England rate cut down the line. It pushed their FTSE 100 index up almost 1%. It just shows how hungry global markets are for any sign that inflation is easing, which just reinforces the anxiety around our own delayed CPI number here.
And casting this sort of longer-term, somber shadow over everything was the IMF, the International Monetary Fund's latest World Economic Outlook. They painted a pretty gloomy picture, didn't they? Global growth slowing to 3.2% in 2025.
Yeah, and what's most relevant for our discussion today are the specific risks the IMF flagged. Rising trade protectionism, government debt issues, but crucially, they specifically warned about the risk of an abrupt repricing of tech stocks.
Abrupt repricing, that doesn't sound good.
No. It doesn't just mean a gentle pullback. It implies a sudden, severe contraction in those valuation multiples, meaning investors just suddenly decide they're not willing to pay 50, 60 times future earnings anymore for those high-growth names. They demand valuations fall back towards historical averages rapidly.
Wow. So when the IMF uses that specific language about tech stocks, and then the very next day we see Netflix and Texas Instruments drop 8–10%, that warning goes from theoretical to feeling very immediate, very heavy.
It connects the dots perfectly, doesn't it? The kind of institutional punishment we saw today aligns exactly with the big risk flag raised by the world's top economic watchdog.
Okay, so with that crucial CPI data pushed to Friday, all that market anxiety, all that pent-up energy, it immediately shifted focus. Where did it go? Straight to the after-hours earnings reports from the tech bellwethers. The market needed an immediate read on risk appetite.
Absolutely. The tension just pivoted directly from the macro vacuum to specific corporate earnings, starting with arguably the biggest high beta name out there, the one that often acts as a proxy for the whole high-growth trade, Tesla.
Right, Tesla, TSLA. First of the Magnificent Seven to report this earnings season. So yeah, a critical test for the whole market, really. This is a stock that's more than doubled this year. Its performance is a real litmus test for how much faith investors still have in that aggressive growth story.
The consensus forecast was for EPS of 0.41 cents, revenue around $26.2 billion. But analysts, they weren't just looking for a simple beat or miss on those headline numbers. They were really focused on three key things, high-stakes scrutiny points. First, what does management say about consumer demand, especially now that some of those EV tax credits have expired? Is the consumer still stepping up?
Second, production scaling. Can they hit their aggressive targets?
Right. And third, maybe most critical, automotive gross margins.
Margins, the lifeblood of the investment case, especially with TSLA cutting prices so much recently.
Exactly. They've been cutting prices aggressively to keep volume up, defend market share. The key question is, are they sacrificing profit to do it? That high growth valuation, it's only really justified if margins are expanding, or at least holding steady. If TSLA reports weaker margins than expected, it confirms the fear that the EV market is maturing fast, getting super competitive, turning into more of a cyclical manufacturing business maybe, not a perpetual tech platform.
The market already took some heavy hits today from Netflix and TXN. What does Tesla's report mean for the rest of the Magnificent Seven and maybe tech overall?
In the very short term, it's probably the deciding factor. A strong TSLA report beating estimates, talking up margins, strong demand that could instantly reverse today's negative vibe. Restore confidence that the growth story is intact, regardless of Netflix's tax problems. But a weak report, oof, that would validate every single fear sparked by TXN and Netflix. Concrete proof that the high-flying growth thesis is cracking. That could easily trigger a much broader, maybe deeper correction across all growth stocks, especially the ones with those nosebleed valuations.
And beyond Tesla, we also had IBM reporting after the bell. Maybe not as flashy as the Mag 7, but IBM plays a key role too, right? As sort of an enterprise gauge.
Yeah, IBM's report is critical for a slightly different reason. It gives us a window into corporate spending, enterprise budgets. Analysts were looking for EPS around $2.44, revenue near $16.1 billion. But the real scrutiny there is laser-focused on growth in two key areas: their hybrid cloud business and their AI segments, especially consulting.
Why is that enterprise spending view so important right now?
IBM's results give you this unique insight into broader enterprise tech spending trends. The big ticket budgets that CEOs and CIOs are actually willing to commit for future projects, for infrastructure. If IBM shows strong momentum in AI consulting and cloud adoption, it suggests corporations are still investing heavily, future-proofing their operations. But if those numbers look soft, it might indicate that CFOs are starting to tighten the purse strings, maybe delaying big IT projects. And that would be a pretty worrying sign for the B2B tech sector heading into Q4.
Okay, we need to bring this whole discussion full circle now. We need to link the weakness we saw in institutional tech and the crazy chaos in the meme stocks, link that to this massive structural risk-off signal that seems to be flashing from the commodity and crypto markets. This great commodity correction, as some are calling it.
Yes, I think this is possibly the most significant leading indicator we're seeing right now for the broader stock market. When you see a sudden, violent unwinding in these high-risk, high-leverage assets, it usually comes before or right alongside a broader drop in risk appetite across the whole financial system. When the most speculative stuff breaks first, it usually means the market is actively deleveraging, taking risk off the table.
Let's look at gold and silver. I mean, gold just hit an all-time high, right? $4,392 an ounce, the ultimate safe haven, supposedly. But the drop since then has been spectacular.
The severity really can't be overstated. Gold futures fell another, 2.37% on Wednesday? Down to $4,026. That was after plunging nearly 6% the day before. That Tuesday drop was the steepest one-day fall in over a decade for gold. And silver got hit even harder, given it has more industrial uses too.
What caused such a sudden violent reversal, especially in gold, the supposed safe haven?
Well, the consensus seems to be a combination of things. Aggressive profit-taking for sure, but also a major leverage washout, specifically triggered, apparently, by President Trump's tariff announcement back on October 10th. See, gold's big run-up was fueled by two things: relentless inflation fears and geopolitical uncertainty. Tariffs, kind of paradoxically, can actually strengthen the dollar. And maybe they dampen some global trade inflation, so that might have pricked the bubble a bit.
And the leverage washout part?
Right. Assets like gold futures, when they're flying high, they attract a lot of leveraged players. Traders using borrowed money to amplify their bets. When the price starts to wobble even a little, those leveraged positions get forced out. Margin calls. They have to sell instantly to cover. That forced selling creates more selling pressure, and boom, you get these incredibly rapid drops. That sudden liquidation event signals that risk tolerance, especially among those leveraged funds, is just evaporating.
And we saw pretty much the same story playing out in digital assets, right? Which are often the first canary in the coal mine when sentiment turns sour. Bitcoin's slide picked up steam again, fell nearly 4% on Wednesday.
Yeah, Bitcoin's now down, roughly 17% from its all-time high. That high of over $127,000 was less than 2 weeks ago. And that pressure cascades straight into the crypto stocks. Coinbase, CoinIn was falling. Those smaller, higher-risk miners like Hut 8, HE, Bitfarms, BITF, they were under intense pressure. These assets, just like gold, had those parabolic run-ups, driven by hopes of Fed easing, pure momentum, speculation. Their sudden collapse just confirms that liquidity is being yanked out of the riskiest corners of the market first.
Okay, so if you put it all together, this extreme volatility, this unwind in the highest risk assets, gold, silver, Bitcoin, what does it ultimately mean for the Dow, for the S&P 500?
It means the market is actively cleaning house, deleveraging. That sudden violent reversal in these assets, it's a classic sign. Investors are pulling money out of the most speculative bets first, fast. Now, if this structural deleveraging starts to converge with fundamental weakness coming from tech earnings like what we saw hints of with Netflix and TXN, well, that's when you get a potentially dangerous feedback loop. That convergence is what could easily trigger a much more significant, more widespread stock market correction. Even if companies like ISRG or GEV report strong numbers, the whole system just feels like it's getting thinner, less tolerant of any mistakes, much more sensitive to risk overall.
Wow. Okay, this has been an incredibly tense day to unpack, but a really insightful deep dive. So, to synthesize, we're navigating essentially two markets right now. First, that cautious institutional market, demanding perfection, brutally punishing any flaw in those high-growth names like Netflix. Second, the speculative retail fringe, driving insane volatility, short squeezes in stocks like Beyond Meat, the overall mood, high anxiety. With all eyes now laser-focused on two huge binary events coming up, the TSLA and IBM reports tonight, and that delayed CPI data on Friday.
Absolutely. The market's next big move really hinges on which story wins out. Was the tech pullback today just an anomaly? Some necessary profit-taking after a big run? Or is it the start of something broader, something driven by fundamentals? If Tesla stumbles tonight, or if that CPI number comes in hot on Friday,
Yep.
well, those fears get validated. And that could converge really dangerously with the deleveraging we're seeing in commodities. You really need to watch those indicators closely now for true directional clarity.
And here's that final provocative thought for you to chew on this week, especially thinking back to that IMF warning about an abrupt repricing of tech stocks. If the most speculative, high-leverage trades out there in gold and crypto are being unwound so aggressively with such violence and speed, how insulated can those high-flying, high-valuation tech stocks really be from that same evaporation of risk tolerance? Regardless of whether they beat revenue by 1% or not, it feels like we're witnessing the market significantly raise the financial cost of any imperfection.
Couldn't agree more. A fascinating and perhaps pivotal moment. We look forward to connecting the rest of the dots with you next time.